Maverick traders, welcome out to your FX and crypto midweek, July 26th. I announced this last week and I'll do the same this week. We're going to go away from the traditional midweek. We're actually going to go to the end of day, and we'll still have one on Wednesday that'll kind of recap and so on. It'll be just a little bit different format, but essentially the same thing. So this will be our final quote-unquote midweek. We'll call it an end-of-day video instead and probably send it out at that time. So just be aware, slight change, but essentially same information, same details. I'll probably still handle that Wednesday class. As always, let's jump into the markets and talk about what's moving, where we're going to go from here.
Would having more trading capital help you meet your trading goals? Maverick Currencies is the oldest US-based Forex and crypto prop firm. We fund traders just like you with 5- and 6-figure accounts where you keep 70 to 80% of profits. Click the apply link on the top right of this video to start the process. This will take you to a 4-minute video that explains the trader position, and you can read a list of FAQs that answer pretty much all the basic questions you have. After that, if you're interested, fill out an application, and then you'll watch the full-length recruiting video and schedule an interview with our recruiters. Are you our next trader?
As we are trading the FOMC. So the Fed funds is expected to raise by 25 basis points from 5.25 to 5.5. Now, when you look at the Fed, remember that the Fed has two policies, two main mandates, and those mandates are price stability, which is inflation, right? Keep prices stable. And the way that they control price stability is through interest rate hikes and different things that way. And then the other is full employment. So they try to, this is the Fed's job, that they try to keep people fully employed, do things that will help the economy that way, and then keep prices stable. Now these can push and pull on each other, because if price stability starts to lose ground, in other words, inflation is running out of control, they're going to have to do things that hurt employment, right? By slowing the economy, raising interest rates, doing those sorts of things. And so when we look at the Fed and where they're at, you have to think about these two mandates and how they counterbalance each other, and then also which one's more important to them at this moment. Because they might say, well, be damned this one, we got to control this one. And right now, this is their focus. For a number of years, price stability was not the issue. In fact, the US has fought deflation, not as much as Japan, but similarly, we've gone through this deflationary cycle, right? Where prices were just, inflation rates were just not running hot. And the Fed screwed up, and they screwed up big time. We saw as big a price spike as we have seen in years and decades, and the Fed at the time said, oh, it's just transitory. Don't worry about it. It'll go away on its own. It was one of the biggest policy mistakes we've seen in our lifetime, and they let price stability go, and they didn't react, and it was a big deal. Prices went out of control, inflation hit near 10% and so forth. So they said, we're not worried about it, and it was a huge mistake. And then they had to flip a 180. They've admitted that they made a huge mistake. They admitted that they acted too slowly and so on. And so that's why I always use the golf analogy. You've heard me say it many times that the Fed dumped one in the water, and now they've got to club up. Now they've got to say, well, we can't screw up price stability a second time. That's just not what we can do. If we hit one in the water, we got to take an extra club and make sure we don't dump a second one in the water, right? And so from the standpoint of price stability being the big issue, they have to raise rates, and they have to make sure that they take a big sledgehammer to inflation, and they don't let it become entrenched, and they don't let it become a huge problem. So now, if we look at it from the standpoint of what the Fed is going to do, if you believe like I do that they're going to sacrifice this to make sure they don't screw this up a second time, where does that lead us? Where that leads us is higher interest rates. So they're going to raise now. Are they going to raise more? And maybe more important, while they may not raise a whole lot more, while we might be in the late cycle of that, when you think about where they're at, they're probably going to keep rates higher for longer, even when we start to see employment take a hit, even when we start to see the economy slow down, even when some of these problems start to pop up because of what they've already done, because they've hiked rates enormously, and we still have full employment, we still have an economy chugging along. There's lag effects, but these are going to get hit. They are. It's a question of when, not if, right? The U.S. has the world has raised rates dramatically, and that means higher cost for business, for employees. When businesses' costs go up, what do? They lay off employees. They do things to cost cut. They've been able to pass on price increases for a period of time, but they won't be able to do that forever. So I think the Fed is willing to sacrifice this side of their mandate to make sure they don't screw this up a second time. And because of that, I think interest rates are not going to be massively cut as dramatically as people expected, in terms of, I don't think that the market is pricing in like 4 interest rate cuts next year and so forth. The only way the Fed's going to cut rates is if something really bad happens within the economy and the employment picture. And even then, they're going to be slow to act. They're going to be higher for longer than the markets realize and anticipate. That's my thesis, and nothing in the data has made me rethink that. In fact, I knew we talked about the inflation rate's going to come down to 3% because of the last 2 CPI numbers were huge drops. But guess what? Now it's probably going to tick back up. Now we're at the tough spot where it's at 3%, and it's going to trickle back up more towards 4%, and their mandate is 2%. So inflation right now is probably going to start to creep back up slowly. And I just don't see it. I don't see the Fed flipping a 180 on this and risking a huge policy mistake a second time. They're worried about their legacy. They're worried about screwing this up so bad that inflation becomes a massive problem in this country. The dollar loses value. All of these things that could potentially go wrong, where maybe the dollar becomes there's so much printing of dollars that all of a sudden it becomes a bigger and bigger problem and such. And so I just don't think they can err on that side at all. Now we look at what they've done thus far. You say, well, it's been historic how much they've raised rates in such a short period of time. Yeah, and it's still creeping upward to 5.5. And I would expect, we'll probably see 5.75 and such. They're not there yet. Now, interestingly enough, when the Fed's hiking rates, when you think about the market, you have to think about cycles that things go through. So sometimes people will ask a question like, well, if the Fed hikes rates, is that bad for this? It all depends, because it depends on where you're at in the cycle. If the Fed is hiking rates back here early on, and you can see that they're going to keep hiking for quite some time, then it doesn't really matter that where you're at. There's so many more rate hikes coming that should strengthen the US dollar long term, right? Where is the Fed at in terms of their cycle? If the Fed is cutting rates, well, it depends on where they're at. When the Feds first start cutting rates, some people might say, well, rate cuts, that should be good for stocks. No. When you first start cutting rates, that's actually horrible for stocks, because why are they cutting rates? Well, something bad has happened, right? Something has gone wrong, the economy's slowing, et cetera, et cetera. So it's not really, it depends on where you're at in the cycle, in other words, and the other factors involved that really tell you more of the story. You have to check a few boxes. You have to say, well, where is the economy? Where is employment? Where is inflation? Where are these numbers and where are they trending? How big of an issue is it? And then start to make a better thesis about it. And so when I look at this and say, what is the market expecting versus what do I think the Fed is going to do? Unfortunately, I guess, because I want to trade certain things, unfortunately, if the Fed is in fact going to keep rates up here for a while and be more aggressive on that side of things, then even though the US dollar has come down some, it probably doesn't have a lot more to go. Meaning, from a fundamental perspective, so let's go to the US dollar index here. From a fundamental perspective, if they're going to not be cutting rates and so forth, cutting rates in an about face would really lead to more dollar declines. We've already gone through, so this speaks to inflation, I think, more than anything else, which is what the dollar has been trending off of. Notice back here when they were screwing up, the dollar was already calling their bluff as inflation started to go. The dollar started to rise before interest rates were ever hiked. And that speaks to the markets being smarter than the Fed, in essence. Look at 2021, the Fed kept their rates down here near a zero interest rate policy. The dollar already started to react and bottomed out. As the Fed began its rate hiking cycle, the dollar took off, and the dollar kept going for the first phase of that, certainly. And then by the time the Fed was really aggressively hiking rates back in here, the dollar had already priced that in to a large extent and started to come off of that. Kind of the buy the rumor, sell the news. So the dollar has come off quite a bit. Now the chart says the dollar is probably going lower. That's what the chart looks like here, right? It's more bearish. It looks like we've broken a level of support here and could use it as resistance, as kind of a move lower. But I find myself thinking that now we're in this transitional period where if you look at where the dollar bottomed, where did it bottom out? Right here? Well, right around the inflation, the CPI number, which showed that biggest drop. Remember, the July CPI was the biggest drop of inflation, and that happened to be the bottom. And now we've started to spike up. I wonder if the dollar's going to rally here, anticipating what I'm now thinking, which is higher for longer. The Fed's going to be more aggressive and such. So I find myself, again, that's not the position I want to be in. I feel like the fundamentals actually lead to some dollar strength. The technicals are showing dollar weakness. That is always a tough dynamic because I'd much prefer that everything just be in alignment. If everything were in alignment, well, we can make a better argument and feel more confident about it. So right now, I mean, I suppose you trade the charts more than anything. The charts are short term, fundamentals are long term. I don't know if the dollar has a ton more downside or any for that matter, but the chart looks like it wants to trade lower. Now, if we were to back this out, this is the dollar index, and this is one of the most widely used charts in all of currency land because it's the long-term US dollar chart, and so many things take their cue from the US dollar itself. We've talked about this before, that there are some key levels on this chart if you were to look at them long term, and it's kind of interesting how these cycles, how these levels work. The difference between 72 and 88 is 16 points. The difference between 88 and 104 is 16 points. So when you're looking at this from the standpoint of key levels, I'm not sure there's any real significance to that, but it's kind of interesting that there's a 16-point difference between this area of support and this area of resistance. I should have put this on more of a linear scale so it doesn't show wider spread, shorter spread, shorter spread. It would be a little bit more spread out. But anyway, that sort of dynamic. So resistance right now for the dollar index would be up at 104. I wonder if we're at least going to go back up in the shorter term and retest that again. Could we head down towards 88 again over time? Maybe, but the fundamentals are what have me a little bit perplexed, because now I'd feel like the market's wrong. And I've gotten some of these cycles certainly dead on. I mean, I talked about back when the Fed, I thought it was making a huge policy mistake. And it wasn't because I was super smart. It was because inflation was at 6 and 7%, and the Fed still hadn't raised rates. Didn't take a genius to say, man, they are screwing this up. What are they doing? They're asleep at the wheel. Inflation's 3 times higher than their mandate, and they keep arguing it's transitory. They're out of their freaking minds. Well, in essence, they were wrong, and they've now admitted as much. But here you start to get into, if we fast forward to CPI, let's go to the next CPI number here in the US, and you'll see it gets a little bit more difficult as we continue to go. Now the CPI, we've got PCE, which is another inflation, and the Fed watches that closely. That's coming out on Friday. But if you look at the CPI, we know that we've had these huge month-over-month drops because, look, we got rid of this huge bar and put in a much lower bar. So inflation dropped massively, right? You look at a chart of inflation, it's all the way down here to 3. Here's the problem. The easy work has been done. Look at the upcoming inflation numbers month over month. We might tick back up. We might get a 0.2, 0.3, and we actually tick back up. So this trend that inflation's been trending lower, it's actually about to take a little mild U-turn back up. And all of a sudden we're going to get inflation annual number. Whoops, I had that zoomed in, but you see that whole trend lower. Now we're about to just make this little turn and start to tick up just for a period of time. So that's a bit of a problem. And this is where we've said after July, it gets really tough for inflation. So that theoretically would be bullish for the US dollar. We'll see if that's the way it plays out, but that's the way that it would be set up. Now, let's go into a few different charts here and just look at these together in terms of things that might be interesting to trade. Now, I'm going to have a special focus on US dollar charts, but let's look at a few of these. So here's dollar yen, USD, Japanese yen on the daily. Choppy, sideways, not too much that I can really add to that. Here's Euro USD, bullish. So if you are bearish on US dollar, you think dollar is going to go lower, this is really an inflection point right here. This is the prior breakout zone. Notice the nice break above. Old resistance from back in April and May. Retesting, could be acting as support, the springboard higher. Euro USD looks solid on the longer term chart for upside trade. Pound USD, very similar to what we just looked at. Notice the breakout point, the retest could be a springboard higher. Looks pretty solid that way. Aussie USD, choppy. You could argue this is maybe an ascending triangle. Okay, I could get on board with that. If you like Aussie, you could play it to the upside. Aussie's been tough though. Aussie has been choppy for some time. Kiwi USD, all of these charts look more bullish than not, I would say. If you draw a little trend line here, let's do it this way. We'll drag a trend line, but I've got to remove that drawing tool. Okay, something along this lines of, hey, did we break out? Now we might be trying to use this old breakout point as a support. Well, maybe. I think that's not my favorite. Here's US dollar CAD. We highlighted this one back when it had the bearish Bollinger Band set up, which worked really well for US dollar to make another leg lower. Now, again, all of these are short US dollar. That's what the technicals point to. Kind of a descending triangle type of pattern. And then last but not least, dollar Swiss franc. You can see the downtrend that persists there. So all of the charts on the longer term on the daily chart look more bearish. Now, if you were to come in to a little bit shorter time periods, then you get a mixed picture, right? Here's the dollar rallying versus the CAD, Aussie selling off versus the US dollar. So on some of these shorter term charts, you could play it a little bit differently in essence. You could actually buy the US dollar versus some things. Some of my favorites are, again, shorting the Aussie versus the USD, shorting maybe the Kiwi versus the USD. These look like more bearish charts. Even the pound, well, not the pound, or the euro, rather. And I'm kind of avoiding Japanese yen on the short side, but I could short dollar, I suppose, against that if I wanted to play it that way. But here's kind of where I've found myself landing. If we look at it from the standpoint of if you wanted to play USD to the upside, which is not really what the long-term charts suggest, your possible plays today, just for a short-term Fed meeting trade, which would be fine, you could short something like Aussie or Kiwi versus the US dollar. If you wanted to play the US dollar to the downside, which is really more of what the long-term charts suggest, then you could buy, okay, so these would both be short. You could buy Euro USD or something like Pound USD more as the upside trade. And that would get you, of course, long the US dollar, or pardon me, short the US dollar versus those currencies. So you're buying euro or pound, you'd be shorting these as the possible trades. I mean, that's where I think the charts and things suggest we're going. So we'll see how the US dollar reacts to this Fed meeting. The part of the meeting that's not a surprise at all is going to be the 25 basis point rate hike. That's coming. So just already figure that's priced into the market. The market already knows it's coming. It's had multiple weeks. It's had many days to digest that. That's not going to be the surprise. The surprise and questionable aspect of it is going to be around what comes next and what the Fed's message is. And at some point, I think the market should be surprised that the Fed is continuing in this vein, that they're going to continue to raise rates and do those sorts of things to be more aggressive, and that they're taking this inflation very seriously, because I think they know it's still a problem. It hasn't fully resolved. If we were looking at it from the standpoint of their numbers and their expectations for those numbers, they're not going to be hitting their goals of 2%. And so you stay sticky up in the 3s and the 4%, that leads to Fed hiking or keeping rates higher for a longer period of time. And that's a bit of a problem. So I don't think they can declare victory just yet. On the technicals, I kind of prefer this. On the fundamentals, I sort of prefer this. I would err on the side of either one of these you're playing short enough term that it's just more about what today's reaction is going to be. And so you probably ignore the long-term fundamentals, and just say, what is today's reaction going to be? Today's reaction could certainly lead towards a little bit more of the US dollar going down. That's certainly a possibility just on today's reaction. I don't know that they're going to say anything too earth-shattering or anything that way. So we'll see what the knee-jerk reaction is, and whether we trust it in that, if there's energy, if there looks like there's going to be follow through. Normally in these types of announcements, there can be phases to it, that you get the first reaction, which is kind of knee-jerk. It's just not very smart oftentimes. More times than not, that knee-jerk reaction fades away pretty quickly. And then the question is, does it just keep, where's the follow-through? Sometimes the knee-jerk reaction, then, it fades away quick, but then there's follow-through in that direction. Sometimes the fade just keeps going. This is more of like where you'd say, okay, what do I expect there's going to be from here? Does the fade continue to follow through? Does the initial knee-jerk reaction actually signal the direction it's going to continue to go? And I trade either one. I will trade either one of those if I can find good risk, reward, probability, and those things start to line up. Yeah, the chart we're on would get you, we would be looking to short Aussie USD, so it would get you long the US dollar. You'd have to think that there's a bit more upside in the USD, at least for the next 24, 48 hours. And if the Fed is more hawkish and surprises the market with its commentary that it is going to consider more rate hikes and such, then this should work. This should work as the trade, which would be a sell-off here in Aussie USD. If the Fed is accommodative and says, hey, we're probably done raising rates and we're not really sure and we're going to be on hold for a while, any sort of messaging that is dovish, this would not work, and you'd more want to go to buy Euro USD or something like that, which would take advantage of the dollar going down, and you would buy this currency to take advantage of that dollar drop. So exactly right.
Do you want to be a professional trader? Maverick Currencies is the oldest US-based Forex and crypto prop trading company that will pay you for trading with our capital. Trade our capital and keep 70 to 80% of the profits. We are looking for traders just like you that are hardworking and motivated. Click the apply link on the top right of this video to see if you have what it takes. That link takes you to a 4-minute video that explains the trader position available, and you read a list of FAQs that answer pretty much all the basic questions you have at this point. After watching the video and reading the FAQs, if you're interested, fill out an application, then you'll watch the full-length recruiting video, and then schedule an interview with one of our traders. Are you our next trader?
Yeah, that's the tricky part of it, is remembering, what gets you long or short. But when you've done it for a long time, it gets a whole lot easier. So we're either going, if we buy something, then we're playing the dollar to go lower. And if we short either of those pairs, we're actually playing the dollar to go higher. That happens to be how it's working today, given the currency pairs that we're looking at. That's correct. All right, so we're about a minute away. And one of the things that I like to do, you could look at the announcement and you could say, so let's go back here. Well, this is fine. We could go see we're a minute away. It's got the countdown here. We know that's going to post 5.5. It's going to have this 5.5% posted right here in a minute. But I like to watch the market's reaction because, again, that number doesn't mean anything. It's what's the other stuff around it, and then watching the market reaction to it. So if we were getting ready for this, we would be ready to short this currency pair, right? We would have a sell order for however much you're trading. Say you were doing 5 lots or whatever, and you'd have a trade set up here to get short Aussie USD. I'm actually going to be trading on a different screen, but that would be the idea for this chart that we're watching. You'd have a short ready in Aussie USD and ready to take some action. All right, the countdown continues. And what you should see is a big energy reaction. Watch this chart here in just a second, and it should sort of spike one way or the other. It might blast lower. It might blast upward. And sometimes there's a little couple of second delay here. We'll see if that's happening right now. So, okay, so see that burst. It shot to the upside. And the question is, in terms of follow through, I think we could get short this currency pair here in a second if it starts to fade away, because you've got a nice stop up above it. And I'd be inclined to put my stop up above that and take a little bit of a chance on this. So I'm going to do it on my other screen right here around 67.50 and put my stop up there above 67.65, and let's see what we get here. So I just got short, and we'll just put a tight stop. I mean, we've only got 16 pips of risk in this. Let's see if this can fade off here. At least going down towards these lows and such would give us about 3 or 4 to 1 type of risk to reward. I'm going to fade the reaction. The initial reaction was for dollar to, again, to sell off a little bit. I said fundamentally I kind of lean towards expecting certain things and dollar strength. So I'm going to play that here in the technicals as well and not really trust that knee-jerk reaction move. You can see it starting to fade off a little. I would not declare victory yet. I would declare victory if this trade succeeds, but it would certainly help us if this goes back towards the lows. If this goes back and gives back all of that, we'll be in much better shape. If it doesn't, if it just stays right here for a little while, we're going to be dead in the water. So that's just the nature of it. And I don't love that it kind of didn't make that next burst. I mean, it's probably not going the right way. Well, certainly, back to our entry point at this point is not ideal. You want to get that fade pretty quick on this. So it really needs to trade back to those lows. And that's where the selling intensifies. That's where all of those trapped bulls now have to unload. And they probably got stops under here and such. So I think we're okay, but we're not great. And we need that to fade away here pretty quick. And you can see it's just not happening. It's just choppy right now. If we look at the other pairs, it's not going to be much better. It's just going to be the choppiness of it all. So you could buy Euro USD. I mean, that was the other idea, and have your stop here. We're doing the opposite of it. I think it makes sense I felt like the Fed's messaging would be more rate hikes are probably coming, more aggressive policy. I think they've got to get that messaging across. So that's why I'm leaning towards the fading. And I think that makes sense in terms of the messaging of the Fed. So you also have to be aware that when it comes to Fed meetings, there is a press conference that comes out. And one of the things that's tricky about the press conference is we've seen some of the opposite type of reaction. So I don't know that I would love to be in anything. It's almost like when you're trading these Fed meetings, you have a trade around this time, and you got to be pretty quick to take profits because, well, at least for the last 10 or so meetings, it's like you flip a 180. Whatever was working here, the opposite works there and such. So that's got to give you a little bit of pause to go into this one just based on the trend. The Fed press conference has really created some 180s from whatever the actual release of the announcement has been. So, I mean, that might give you a little bit of confidence if you're on the wrong side of the trade, but it would give you pause if your trade's working. You'd be antsy to maybe take those profits and not be in it still when that press conference occurs. So I'd probably be in that boat where I would try to be out of this in the next 30 minutes. Price targets, I mean, heck, if you can get down here into this 67.20 or so level, like we said, that's about 30. I mean, right there where I've got highlighted is about 32 pips of profit, and we're risking 16 pips. So you look at it, it's 2-to-1 reward to risk in our favor. But we'll see. We'll see what happens here in the next few minutes. So far, just pretty much sideways. It's right at our entry point right there. But that's, like I said, not great news because you'd wanted to see that fade away. And it's just not fading. Every time it tries to fade off, there's some more buyers. And then it tries to fade off, and there's more buyers. And it just keeps it sticky here, which might just be choppy rather than any real follow through. Maybe it's a dud. That's certainly possible. But I would hopefully we could be out of this trade down here towards this 67.18, somewhere down around there before the press conference occurs, lock in our profits and move on from the trade. Yeah, I mean, we're up 2 pips, 3 pips in the trade right here, but I'd feel a lot better. I mean, it's not very much, but just giving back those gains and turning this into a high wave candle would increase your probability of success immensely towards hitting that target. So that's what we're certainly rooting for at this time based on that trade. All right, we'll leave it there. I don't really have anything else to add in terms of my outlook or expectations. So hope you've enjoyed today's Fed meeting. Hopefully we've got a good trade here that will work back down there towards those lows, and we'll be able to lock in some profits. As such, you'd look for the press conference, and if the press conference gives you another setup, you might be able to reinitiate a whole nother trade and do it again. So we'll see. Thanks again, everyone, for being here. We'll see you next time. Goodbye.